Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for you in light of your financial condition.
Good morning. It's Wednesday, February 11th. I'm Phil Streible, Chief Market Strategist at Blue Line Futures. So let's get you set for the trading day ahead. We've got gold, silver, platinum, palladium, and copper all higher on the day, really supported by expectations of a more accommodative Federal Reserve. And this comes after weak U.S. data signaled a slowing consumer spending and rising some growth concerns. Now, weak economic data releases fuel those interest rate cut expectations. They drive yields lower and they drive the dollar index lower. Yesterday, we saw the weak retail sales and over one of the most important times of the year for that particular reading. Today, we'll see U.S. payroll data. The forecast is for 66,000 jobs created. However, some of the whispered numbers I'm hearing are in the 50s and even into the 40s. The unemployment rate is set to be anchored at 4.4%. Now, on Friday, we'll get the CPI data. So there's quite a bit of data here between now and the end of the week. And what that'll do is that'll move the needle as far as that next interest rate cut. You look at April gold overnight, the lows 50.4630, again above that 5,000 level. The highs of the overnight session here 51.44.5. We're just coming off those highs here as of this recording, sitting up about $106 at 51.36. You look at those key levels of resistance, breaking through that first one at 51.21, followed by 54.50, and the contract highs here seen on January 29th at 56.28.80. Your key level of support going to be that 5,000 mark just for psychological purposes, below that 49.37 and then 46.80 way down there. We don't want to see those kind of lows being hit here, and that was the January consolidation highs. Now the 10-day average true range continues to slide here. About $227 a day is what we're seeing as far as volatility, but as far as volatility is concerned in the gold market, yesterday's consolidation across many of the different markets here was a healthy consolidation because we saw declining volatility in not only gold but also in silver. The gold volatility index dropped to 28.86 after peaking at 48.68 on January 30th. So breaking below the 40 threshold, that's where there's complete panic in the market. And when you set stop losses for intraday trading, most likely just that back and forth volatility, you're probably going to get stopped out. You can't put reasonable stops in, is what I'm telling you. When you get gold volatility at 40, that's where you really want to back the chart up to those daily and those weekly levels here and look for longer term levels of support and resistance as far as any kind of tactical entry and exits are concerned. When you get gold between 40 and 30 volatility, it gets very choppy around there. So they kind of whipsaw, leave some open tails back and forth. And that's where you also get stopped out quite a bit as well. It goes through these periods where it seems to be a bit of organized trading, and then it goes to chaotic trading and back and forth, and that's between 30 and 40 volatility. When you drop below that 30 level, what we're seeing right now, a bit more organized in the trading, and you could look at an intraday chart here, and you could see that the movements are a bit more organized, in my opinion. So if we do get that sustained break above the next level, which is about 51.50, I really believe that it could open up the door for another move to 54.50, especially if this U.S. economic data continues to weaken, supporting a lower dollar and lower treasury yields. Now you look at the silver market here. Overnight, those lows are at 80.41. Last of this recording here, 85.66. Highs of the overnight session, 86.20. So silver up about 6.5%. That next resistance level on silver looks like possibly $90 just for psychological purposes, but 93.56, followed by 100 again as a psychological level and $101.44. That January 29th high before the big collapse was 121.78. The 10-day average true range continues to drop here at about $11.07, and you do have silver volatility collapsing down about 13% at 80.97. So you look at the ETF flows here because it's important. You got the ETFs, they're starting to buy gold, silver, and platinum. They're selling a bit of palladium. It was no real material change, adding about 7,600 troy ounces of gold yesterday. In total, gold held by ETFs up about 1.1% this year, sitting at 100 million ounces. Gold is up about 16% before this recording, so about 18% year to date. You look at the silver ETF flows, essentially unchanged, but adding about 21,000 troy ounces in that previous trading session. Something to note is that ETF flows on silver have not been positive at all this year. They're down about about 2.4% coming into the end of the year. A lot of that profit taking place here, alleviating some of those ETF flows. And then just because the volatility exploding out on silver, it became more of a day trading affair, and money managers were more trimming some of their exposure to beta adjust the size. Now you look at the gold silver ratio dropping to 59-1 here after 62-1 yesterday. You look at the macro markets, the equities, well, stock futures just slightly higher here, essentially flat as we're waiting this payroll data. You look at the earnings out of the 326 S&P 500 companies that have reported so far this year, this season. We have 78% of them have managed to beat analyst estimates, while 17% have missed. The earnings on the Russell 2000, some of the small caps, much better here than what we're seeing in the NASDAQ, the mega cap, because of the fact that they're really just starting to cannibalize themselves as far as you're hearing about these disruptors. It was another one where it was an AI type of engine that created an accounting type of software that was able to help people with tax purposes, and you're seeing some of the large tax preparation companies being hit overnight. Just a day or two ago, it was a human resources AI application that was hitting things as well. So AI is really disrupting. It takes a lot of CapEx around it, and what you're seeing is small cap companies, smaller operations like myself and things like that are able to incorporate some of these tools, and it makes my productivity a lot better. That's why in real world terms, you see small caps doing a lot better here than the S&P 500, the mega cap, and things like that. Now, we do have that non-farm payroll data coming out at 7:30, and then we'll have the Fed budget here balance coming out later on this afternoon. You are going to have a few Fed speakers. You'll have Bowman, Schmidt, and Hammock all at speaking events, and you look at those interest rate cut expectations for March 18th. This is a big boost here, back up to about 21.6%. I don't think they'll cut rates in March unless we have a material collapse and a lot of different aspects of economic data here, but you'll see on June 17th, we have a 77% and rising chance of an interest rate cut. Also, Powell will be alleviated from his shift there, and we'll have that new Kevin Warsh in place. You look at the dollar, that big lower high that we saw on February 5th at 97.87, we're continuing to see that sell-off here today, 96.55 last, dropping about 0.1%. The correlation between the dollar and gold sits at about 80% inverse correlation. You look at Bitcoin and you look at the dollar, well, they're positively correlated right now. So when you see dollar weakness, oftentimes you could associate that with Bitcoin weakness, which is sitting at about 67,000. You look at the VIX futures below that 20 mark at 1879. WTI crude oil futures, and this might come back to bite us farther down the road, because you are seeing natural gas prices lower, but you're also seeing crude oil prices tick up. Perhaps we are seeing some of the geopolitical tensions rising in the Middle East. That's helped supporting it. We are going to have some data come out here as far as EIA data. Yesterday we had API data, but those rising oil prices, if you're a gold bull, unless it's strictly tied to geopolitics, you really want to see oil prices come down, because it'll take down the CPI data and things like that, and it'll create more easing for the Federal Reserve, helping boost the gold market, helping take down treasury yields, and help take down that dollar index. And you look at treasury yields sitting at about 4.14%. You go over to Europe and Asia, the European stocks, they paused their rally near the record highs here. You had a mixed bag of corporate earnings. And the S&P 500, do yourself a favor, look at a daily chart, look several months out, and you can see that we're kind of trading in this range here for about 150 points. We get up to just north of the 7,000 mark, and then it seems like a rug pull or some kind of episodic and non-trending type of event, like it's Greenland one day, it's DeepSeek another day, it's something else that's coming out and it's causing these problems here. Software stocks, and they all get hit, but we're really in this trading range back and forth. And you look at Asian stocks, will they climb to another fresh record high led by tech shares here? Investors are rotating away a lot of U.S. assets amid this weaker dollar here, in the MSCI Asia Pacific Index rising about 1.1% for a third straight day. You know, something that I see circulating a lot on Twitter is that I was just reading this lengthy tweet here, and it was talking about the open interest on the silver market, the number of inventories at the COMEX. The COMEX is not designed to be this, like, you're going there like it's a coin shop and buying, you know, bars of silver and removing them from the exchange. It's provided to be a liquidity tool, a hedging operation tool. I have a lot of clients that are short on the metals contracts because of the fact that they're hedging inventory, they're hedging forward production, they're refiners, things like that. I have a lot of traders on here that are just trying to make a buck in the metals markets here by buying some of the futures contracts. And this is where things come together, price discovery happens, and we see things move around, and it solves for both purposes. We don't have people opening up accounts here to specifically remove silver from the warehouse. And I could tell you the pain that it was just to sell just a couple hundred ounces out there. I couldn't imagine having to deal with 5,000 ounces, let alone lugging them around in my car. Your gas mileage got to go down significantly with 350 pounds or 60 pounds of silver in your trunk here. Plus you leave yourself open to God knows what, as far as, safety concerns with that much. But the reality is that there will not, all the markets out there, it doesn't matter if it's corn, oil, gasoline, natural gas, or anything, copper. If you took delivery of everything that's out there, yeah, it's more contracts in an open interest than there is available reserves on there. But I'm telling you that the exchange is not designed to be that way, and 98% of all futures contracts are offset prior to the expiration because of the fact that speculation and also hedging is what the name of the game is in this market, not delivery purposes. So you guys got any questions, shoot us a call, send an email, info@bluelinefutures.com. Remember, futures and option trading does involve risk of loss, may not be suitable to all investors. Good luck, good trading.
Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for you in light of your financial condition.